Friends, I welcome you all to our today's session. We will be discussing some more perquisites today. Few perquisites we have already discussed in our earlier session. And in the previous session, we are discussing about medical facilities. So let us continue from that. Let us quickly recapitulate the concept of medical facility. Then after that, we'll be proceeding. Just give me a moment. I'm going to share the screen with you right now. Well, friends, this medical facilities, if sometimes employers provide medical facility to their employees. And in this case, how the value of that perquisite will be decided, will be computed, that we had discussed in our previous class. So we are going to recapitulate that thing quickly. So you see, medical facility is different from medical reimbursement or from medical allowances. And we are already aware of that a fixed medical allowance is fully taxable. It is to be added to the salary if it is an allowance. But here we are not talking about allowance, we are talking about medical facilities. And for the purpose of taxation, we are classifying this medical facilities broadly into two types. One is medical facilities which are provided in India, then medical facilities provided outside India. If it is provided in India, then we can also subclassify them to see whether it is provided at the workplace itself, or it is provided in a government declared hospital, or in some other places. In case it is provided at the workplace. Workplace means it may be office, maybe factory, maybe let us say where business activities are normally carried out. So if it is within the workplace, or if it is in a government declared hospital, then it is not taxable at all. It is fully exempt. But if it is provided at some other places, and if it is for some specified diseases, then also it is not taxable. What are the specified diseases? You can once again have a look at those diseases which are provided in Rule 3A of Income Tax Rule 1961. These are the specified diseases. So if medical facilities are provided at some other places, but for these diseases only, then also it is fully exempt. Okay. Do you see this list of diseases? Okay. Now, if it is at other places, but for some other diseases, not those diseases which are listed in that rule, then it is taxable. Then it is fully taxable. Okay, other places and for other diseases, then it is taxable. I think this concept is clear. And if medical facility is provided outside India, then we have to classify the entire facility into three categories. It may be a travel expenditure. The employee or his relative might have traveled from India to abroad. The travel expenditure, stay expenditure, and medical expenditure. Friends, you see, travel expenditure is exempt if gross total income is less than 2 lakh rupees. Stay expenditure and medical expenditures are exempt to the extent RBI permits. If RBI has permitted up to a certain limit, then up to that limit it is exempt. Beyond that, it will be taxable. Did you understand the concept of medical facility?
Yes, sir.
Same thing what I told you. It is written in this slide. So you know, amount payable for treatment outside India, medical expenditure to the extent permitted by RBI is exempt. Okay, and if the gross total income before traveling expenditure, before this traveling expenditure of employee does not exceed 2 lakh rupees, travel abroad for patient and one attendant is fully exempt. Stay in abroad for patient and one attendant is to the extent permitted by RBI that is exempt. Fixed medical allowance is always chargeable to tax. And you see, this medical facility may be provided for family. And as we have discussed earlier, family means spouse, family includes spouse and children. They are also family of the employee. And family also includes parents, brothers, sisters of the individual, or any one of them who are wholly or mainly dependent on individual. So spouse and children may be dependent, may be independent, doesn't matter. But parents, brothers, sisters, they should be dependent. If they're wholly dependent or mainly dependent, then only they will be included in salary. They included in the definition of family. Okay, friends?
Yes, sir.
Okay. So I repeat what I said, medical facilities outside India. So, employers, sorry, first let us see medical facilities in India. We have seen it in the chart. Now, what you saw in the chart, in the text, you can see it here. The employer's hospital, if medical facilities is provided in India, in the employer's hospital or government hospital or approved hospital, then it is not chargeable to tax. But how to know that who is, whether it is employer's hospital, government hospital, approved hospital? We have to see. If the hospital is owned and maintained by the employer, then you can say it is not chargeable. Owned and maintained, previous session we are discussing. Nowhere it has been said it is fully owned or fully maintained. So one can take advantage of this loophole of this law. Okay, maybe some contribution for maintenance can also be sometimes interpreted as maintenance. Okay, an employer may contribute some money to an hospital towards maintenance and claim that this is a hospital maintained by us. Is it not? And hospital of central government, state government, and local authority, if treatment is given in this hospital and this facility is provided, that is also fully exempt. Private hospital, if it is also recommended by government for treatment of government employees, certain private hospitals also recommended by government for treatment of government employees. So if treatment is provided in that hospital, then also it is exempt. And specified medical facilities, which is given in Rule 3A in a hospital that we are aware of. We have seen what is Rule 3A. So that is also exempt. Health insurance premium, if it is paid or reimbursed by employer, it is not chargeable to tax. But any other expenditure incurred or reimbursed by the employer for providing medical facilities in India is chargeable to tax. That means, friends, what we have understood. Fixed medical allowances are chargeable to tax. Reimbursements are chargeable to tax. Okay, allowances are chargeable, reimbursement is chargeable. Medical facilities are exempt to certain extent and subject to certain conditions. And coming to medical facilities outside India, what we saw in this chart, we have seen it is taxable, but subject to certain conditions. If the facility is provided for medical treatment, then to the extent it is permitted by Reserve Bank of India, it is allowed. Allowed means it is exempt. Cost of travel is exempt provided the gross total income does not exceed rupees 2 lakh. Cost of stay is exempt provided the expenditure it is exempted to the extent permitted by Reserve Bank of India. These three things I had already shown you in this chart itself. So with this, friends, I think you have understood how this will be taxed, medical facilities. Right. Now tell me, suppose an employer reimburse medical expenditure of an employee. Will it be taxable or not? Is it chargeable tax or exempt?
Sir, exempted.
It is.
Exempted.
Answer is no. Reimbursements are not exempt. Reimbursements are taxable.
So
Medical.
actually, the sum paid by the employer for any kind of expenditure actually incurred by the employee in the hospital. So it don't form any kind of perquisites.
It doesn't show any kind of.
It won't form any kind of perquisite. It won't come under
No,
perquisite.
whether it is profit or not, your logic is that your law, you see, we are not going to apply logic in law. So your point is that money has been spent and that has been reimbursed by employer. He has not earned any profit. That is not the thing. Okay, that is not any profit, but it is the obligation of the employee to meet that expenditure, and that obligation is met by the employer. So employee's obligation made by employer is a perquisite. Okay, so that will be taxable. Is it clear to you? It's
Yes,
not
sir.
that he's earning any profit or not. Okay, so don't get emotional with that. So I have remembered there was a question long back in one of the professional institute. The question was given background like this, that the patient is suffering from cancer, and okay, this thing has spent this much of more money, patient passed away, and the company reimbursed this much of money with, and it is a part of the question, and you have to arrive at what is whether it is taxable or not. Some student got emotional. They said, okay, patient was suffering from cancer, he passed away, got emotional, thought, okay, let us not tax to him. But that is not the case. Reimbursements are invariably taxable. Allowances are invariably taxable. Okay, right. There was a time some years back that allowance the reimbursement were exempt to the extent of 15,000 rupees per annum. So I don't want to confuse you with that. The latest law is that it is not taxable. Sorry, it is not. It is fully taxable. It's not exempt. Okay. Sometime
Yes, sir.
back there was an exemption of 15,000 rupees. So whatever amount is reimbursed minus 15,000 rupees, balance amount was taxable. That was the thing. But now it is not so. Right. So friends, what I feel are these things, let us do a small exercise on this medical facilities. This will clarify some of your queries. Uh, just let me share my screen with you. Give me a moment for that. Friends, I'm showing you one Excel file. Is it visible to you? Are you able to read, or you feel font size is too small? I'm trying to make it a little bigger. Is it okay now?
Yes, sir.
Now have a look. The question is like this. Medical facility, from the following details, find the taxable value of the perquisites in the hands of Mr. Y. It says fixed medical allowance rupees 3,000. Okay, next is this 20,000 is actually value of medical treatment in a dispensary maintained by the employer. Okay, so that is given like this. Uh, okay, let us say this fixed medical allowance is 3,000 rupees. This 20,000, what is that? For the time, let us ignore it. Medical treatment in a dispensary maintained by employer. You see, for Mr. Y, Y is the employee, 5,000 rupees. Mrs. Y, 3,000 rupees. Minor son of Mr. Y, 2,000 rupees. Independent major daughter of Mr. Y, 3,000. Dependent younger brother. Dependents will be allowed or not? Exempted or not?
No, sir.
Dependent, yeah, dependent brothers and sisters. If facilities provided to them, that can be exempt. The dependent younger brother, the dependent elder brother. Now have a look at this solution. So you see, it says fixed medical allowance per month is rupees 3,000 rupees. So it is fully taxable fixed medical allowances. So 3,000 to 12 months is 36,000. Next is, in fact, this 20,000 is medical reimbursement. So let me write it here, medical reimbursement. Reimbursement of medical bills. What will be treatment of this 20,000? This is for his own bill. What is the treatment? Yes, right. 20,000 will be taxable. I told you now 20,000 will be taxable. Exemption, no exemption, fully taxable. But earlier there was an exemption of 15,000. You could have claimed and 5,000 would have been taxable. But today it is not so. So it is fully taxable. Understood? So no deduction of 15,000.
Yes, sir.
Now coming to medical facility. Mr. Wife, that means for self, it is fully exempt. For Mrs. Wife, it is fully exempt because wife is a part of family. Minor son, own children, you see whether they're minor, major, dependent, independent, doesn't matter. It is always fully exempt. Independent, major, daughter, doesn't matter. It is again fully exempt. Okay, I told you boy, girl, independent, dependent, minor, major. If their employees old children, it is fully exempt. But younger brother of Mrs. Y. Okay, he is in that case, it will be taxable. Okay, 5,000 rupees is given to the younger brother of Mrs. Y. For he is dependent. Even if he is dependent, he is not employees related. Okay.
Yes.
Then dependent younger brother of Mr. Y. Okay, for Mr. Y, it's okay. It is exempt because his brother is dependent. And independent elder brother of Mr. Y. This is also not allowed. Okay. So this is again taxable. So total taxable amount comes to 36,000 allowances, 20,000 reimbursement, and 5,000 plus 6,000, 11,000 as the medical facility. Total comes to 67,000. Did you understand?
Yes, sir.
Okay. Okay, I would like to once again take you to one previous slide. The meaning of family, you see. Spouse and children of individual. That is not church. But parents, brothers, and sisters of the individual. That will be exempt only they are wholly and mainly dependent upon the individual. If they're independent, it will be taxable. If they're dependent, it will be tax free. Understood? So medical facility part, I think we have finished. Now, friends, let us learn the next project. You see, this is car facility. Car facilities means employee is provided with a facility of with a car facility. It's not about reimbursement of car allowances, but car is provided, employee is used. Now you see there might be several combinations here. Car may be owned by the employer, may be owned by the employee. Car may be maintained by the employer, maintained by the employee. And car may be used for official purposes, or maybe for personal purposes, or maybe for both. Right? So in this case, how to value this facility? To value this facility, we need to refer to Income Tax Rule 3. Income Tax Rule 3, Sub Rule 2 talks about this. Okay, this is what we are showing in the table. It is a summary of these provisions, which is there in the rule. 10 combinations we have seen. Now watch it carefully. First column is the serial number. Okay. Second is who is owning the car. Is it employer or employee? Next column is who is maintaining the car. Next, what is the purpose? Finally, we'll say what is the taxable value. Now you imagine a situation. Car is owned by the employer, car is maintained by the employer and used for official purpose. owned by employer, maintained by employer, and but car is used for official purpose. Do you think it is a perquisite? Whether employee is getting any benefit out of this?
No, sir.
No. Consequently, taxable value is nil. So whenever you see car is used for official purpose, here is you see one more situation, car is used for official purpose, then taxable value is nil because it's not a perquisite. Okay, when it is a personal, when it is used for personal purpose, or it is used both for official purpose or and as well as personal purpose, then only there is a possibility of personal benefit, and consequently that may be treated as a perquisite. Okay, friends. So car owned by employer, maintained by employer, and is used for official purposes, taxable value is nil. But car owned by employer, maintained by employer, but used for personal purposes, here employee is getting benefit or not?
Yes, sir.
Here you see the actual maintenance cost plus 10% of original cost of the car. For maintenance cost, whatever employer is spending, that is to be taken. Let us say employer is putting petrol on it, then the petrol cost plus repair maintenance cost plus 10% of the original cost of the car. That will also be included. For maintenance actual cost, and for the car 10%. Understood?
Yes, sir.
Now, situation 3. Employer's car, employer is maintaining, but it is for both. It is for official purposes as well as personal purposes. That means employee is definitely getting some benefit. Then it is really difficult to practically segregate how much is the personal, how much is for personal use, how much is for official use. So the rule has suggested we have to see whether it is a small car or a big car. Small car means up to 1600 cc or 1.6 liters of engine capacity. If that is so, then the value of perquisite will be how much? How much is the perquisite?
1800 tons.
Yes, 1,800 per month. And if it is a big car, meaning the engine capacity is above 1600 cc or 1.6 liters, then the value of that perquisite will be 2,400 rupees per month. Okay, so 1,800 or 2,400 per month. It depends whether car is a small car or a big car. Situation 4. Employer's car, employee is maintaining. Employee is maintaining, but it is used for official purpose. If it is used for official purpose, it is practically not a perquisite. Taxable value is nil. Situation 5. Employer's car, employee is maintaining, used for personal purpose. When it is used for personal purpose, since employee is maintaining, so maintenance cost will not be included as perquisite because employee is paying his own pocket. But for use of the car, which is owned by the employer, 10% of the original cost of the car shall be taken as taxable value. Understood?
Yes, sir.
Now, let us see the next situation. Next situation, you see, employer's car, employee is maintained and used for both. Okay, first case, we have seen a similar situation. You see, employer's car, employer is maintaining and used for both. But here situation is employer's car, but employee is maintaining. And it is used both for official purpose as well as personal purpose. Then it is really difficult to segregate how much is for official purpose, how much is personal purpose. But however, a logbook can be maintained and accordingly one can segregate. But if that is not there, the rules are this. We have to see whether it is a small car or a big car. If it is a small car up to 1,600 cc or 1.6 liters of engine capacity, then taxable value will be 600 rupees per month. Because employee is already maintaining only for employer's car is there. So for car, it will be rupees 600 rupees per month. And if it is a big car, above 1600 cc or 1.6 liters of engine capacity, then it will be 900 rupees per month. Okay. Situation 7. Employee's car, employer is maintaining. And for official purpose. Since it is official purpose, taxable value is nil. Situation 8. Employee's car, employer is maintaining. And for personal purpose. Car is employees, employer is maintaining for personal purpose. Since employer is maintaining, the actual maintenance cost borne by employer shall be the taxable perquisite. Situation 9. Employee's car, employer is maintaining for both. Who is maintaining? Employer. So you have to find out how much cost employer is incurring. Minus. Then from that amount, we will be deducting either rupees 1800 per month or rupees 2400 per month. It depends whether the car is a small car or a big car. If car is a small car, then from the actual expenditure income, since it is employee's car, so 1800 rupees per month will be deducted. And if it is a big car, then 2400 rupees per month will be deducted. Understood? And if it is employee's car, employee is maintaining, then it is not a perquisite at all. So the taxable value question doesn't arise. Friends, did you understand?
Yes, sir.
Okay. So this is the rule. You can refer to the rule. You can visit to the Income Tax Department website and visit to the rule 3.2. Okay, so you can see all this thing. But what I showed you is a summary of this. But again, I will suggest that you need to visit to the department website and refer to the rules. In that process, you will be able to be familiar with the text of the rule. Okay, friends? Now,
Yes, sir.
some related points as regards to this car facility perquisite. First of all, if the car is hired, then actual hire charges shall be considered instead of 10% of original cost. So friends, you see, when we are arriving at this value of these perquisites, you have seen in certain situation, let us say here is employer's car. So 10% of the original cost was taken. No, here also it is employer's cost. So 10% of the original cost was taken. But now you see, if it is employer is not the owner of the car, rather employer has hired the car and provided it to the employee as free car facility. In that case, instead of 10% of the original cost, actual hire charges shall be considered. Okay. Okay, friends.
Yes, sir.
Now one more thing. If employee is maintaining a logbook, if a proper logbook is maintained, then higher deduction can be claimed. Okay, higher deduction can be claimed if proper record, that is logbook, is maintained and certificate is obtained from employer. For example, if employee maintains a logbook and clearly specifies that this is for official use, this is for personal use, and on that basis he claims actually more money has been, or that you see car is used more for official purposes, then proportionately he can claim more deduction. Okay, so that is possible, but for that thing, what is required? Number one, proper record. Logbook should have been maintained, plus a certificate should be obtained from the employer. Employer must agree to that this is for official purpose. Did you understand?
Yes, sir.
Right. Now, friends, when we are valuing the perquisites, we have seen some cases we have taken 2,400, some cases 1,800, 900, 600, like this. Please remember that these are the statutory amounts. Okay. And the amount charged from the employee shall not be deducted. Normally, we have understood that when we are valuing a perquisite, let us say for rent-free accommodation, we are valuing. If some money is recovered from the employee, what we do? We reduce it from that value. Is it not? So if when you value a perquisite, you see this is the value of the perquisite, but employee is paying this one. Employer is recovering something. That means it is not a free facility, it's a concessional facility. In that case, whatever value, whatever money which is recovered from employee, that is normally deducted for the value of perquisite. Yes or no?
Yes, sir.
Yes, we have discussed it in the last. But in this case, when you are valuing the perquisite of this car facility, nothing will be deducted from the statutory amounts because these are the fixed amounts. Okay, so this point you have to keep in mind. Amount charged from employee shall not be deducted. And if this facility is provided for part of the month, it shall be fully incurred. If it is provided for the full month, then only the facility will be taken into consideration for valuation of perquisite. If it is for a part of the month, then it will not be treated as a perquisite at all. Understood, friends?
Yes, sir.
Now, some related points again. Car with chauffeur facility or with the driver facility. Car is provided. In addition to that, driver is also. Okay. Then here you have to see what is the purpose for which car is used. First case you see provided, that means a driver is provided along with car facility. And the purpose is for official, second for personal, or maybe third is for. Then taxable value of this driver or chauffeur is like this. If it is for official purpose, taxable value is nil. If it is for personal purpose, then driver's salary shall be added to the value of car purchase. And if it is for both, then a fixed amount, that is 900 rupees per month, is to be added to the value of the car. Understood? If a driver is provided, this is how it will be valued.
Yes, sir.
Okay. Now, next case is that only driver is provided. That means employer has not provided any car facility, but only driver is provided to the employee. In that case, driver shall be treated as a domestic servant. The same way, it will be taxable. The domestic servant facility, it is fully taxable to the extent cost of the employer. That means the salary employer is paying, that amount will be the value of this purchase. Okay, so that amount will be added to the salary of employee as value of this purchase. Okay, friends.
Yes, sir.
Now, here we'll be talking about not about car, it is about some other vehicle. Maybe a two-wheeler, maybe a three-wheeler, anything. Not a car. When I say not a car, try to understand. Jeeps are also cars. Okay, that has been clarified in the rule itself. Now you see some other facility, some other vehicle facilities provided. And here also you have to see the situation. Owned by employer, maintained by employer, and it is for official purpose. So taxable value is nil. But owned by employer, maintained by employer for personal purpose. Okay, owned by employer, maintained by employer. Since it's personal purpose, So 10% of the original cost plus maintenance charges borne by the employer is taxable in the hands of specified employees. Here it is important that is taxable in the hands of specified employees. Okay, who are the specified employees we had discussed in our previous sessions? Situation 3. Employer's car, employer is maintaining, but it is for both for personal purpose as well as official purpose. Then reasonable proportion of 10% of the original cost plus original cost plus maintenance charges borne by the employer. That means just like the previous situation, we have find out what is the 10% of original cost plus maintenance charges borne by the employer. Then we'll find out a reasonable proportion. Okay, reasonable proportion may be 50-50, or maybe if some record is maintained on that basis, it can be distributed. And whatever is attributable to official purpose, this is not taxable. But to the extent it is attributable to personal purposes, it is taxable. Situation 4. Employee's car, employer is maintaining, and it's for official purpose. Official purpose, so taxable value is nil. Situation 5. Employee's car, maintained by employer and for personal purpose. Okay, since personal purpose and it is maintained by employer, so maintenance charges borne by the employer is taxable in the hands of all employees. Situation 5. Employee's car, employer is maintaining for both. Then maintenance charges borne by employer minus ₹600 per month. Higher amount can be deducted with proper record and certificates. Okay, and it is also taxable for all employees. So this is the rule. Just have a look at this rule at appropriate time. If when you need, then you can refer to that. Again, I repeat, once you have some idea that this is the rule, in a real life situation, if you at all face this kind of situation, that you see some employers are providing this kind of facility to their employees, how to value that thing, then please read the rule, refer to the rule, and decide how that will be taxable. Okay, friends. So car and other vehicle part is over. Now let us move to the next type of purchase. This is about, as you can see, free meal. So some employers, they provide free meal to their employees, free lunch. You can say. So this free meal, how that will be valued, we are going to learn. Here again, we'll classify the situation where this free meal is provided. If it is provided at a remote area, offshore installation itself. So there is an offshore installation, or it is a remote area in that place, this free meal is provided, it's not taxable. Next situation is that if it is provided at the business premises, in the office, factory, etc., it is provided. But how it is provided? It may be provided, either food may be provided, or it may be provided through non-transferable coupons or electronic food cards. Non-transferable coupons means some food coupons will be given to the employees. Employee can go to a restaurant and in gas it can have food there. Okay, but here you have to see this coupon should be non-transferable. That means only employees should be able to use that. Right. If it is transferable, then actually these conditions are not met. Consequently, it will become taxable. So employers should ensure that it is a non-transfer. But practically, some of you might have seen that these food coupons are also used by other people, employees, family members, let us say, outside results they're using. Is it not? So employers should take reasonable steps to ensure that it is not transferable. Okay, and if food is provided in the premises or outside the premises through non-transferable coupons or electronic food cards, Employer may provide electronic food cards. These cards can be used to have foods outside. If this is so, if this is how food facilities or free meals are provided, then it is not taxable up to rupees 50 per meal. But beyond 50, it is taxable. Suppose the meal costs 60 rupees, the 10 rupees will be taxable, but 50 rupees will be exempt. Understood? But again, this food should have been provided in the office. And if at all outside the office, it should be through non-transferable coupons or through electronic food card. Okay. So remote area offshore installations are fully exempt, not taxable. At the business premises are exempt up to rupees 50. Beyond that, it will be taxable. In any other case, actual cost incurred by the employer will be the value of purchase. So in any other case, there is no exemption, nothing is free. It will be taxable. But here, friends, you remember, refreshments are not taxable. Here, this facility we are talking about is about the pre-meals. Refreshment means tea, snacks, non-alcoholic beverages during working hours are not taxable. Okay. So during working hours, the snacks is provided, it's not taxable. But if meal is provided, it's taxable to the taxable beyond rupees 50. Okay.
Yes, sir.
Now, next one more type of perquisite. See on the salary, you can see various types of perquisites. Here, now we'll be learning about this thing: travel, tour, or holiday home facilities. Some employers provide this facility to their employees: travel home facilities, tour home facilities, or holiday home facilities. And how that will be taxable? How to arrive at the value of that perquisite? For that thing, we need to refer to Rule 372. And the summary of that rule is there in this table. If the holiday home facility is provided, then taxable value will be the notional market value of such facility. That means we have to find out what is the market value of that facility in the similar place, similar area. And if these holiday homes are also open for all, how much it is charging from outsiders. So that notional market value will be taken. Right. So official tour expenses are reimbursed. Let us say employee is going on an official tour and his tour expenditures are reimbursed. It's an official tour. In that case, nothing will be taxable. Okay, holiday home facility is taxable, but tour expenditure reimbursement is not taxable if it is official. Now, next is a typical situation. Official tour and the family members accompany and the tour expenditure is reimbursed. Let us say there is an official tour for employee. Employee is going on an official tour, but along with him, he is also taking the family members. And the entire tour expenditure, that is employee's own expenditure as well as family members' expenditures, are reimbursed by the employee. In that situation, expenditure incurred for family members will be the value of perquisite. But expenditure incurred for the employee himself is not a perquisite because it is for official tour. Okay. Understood?
Yes, sir.
Now, situation 4. Official tour extended for personal purpose. That means, let us say official tour is for 5 days. Employee stayed another 3 days for personal purpose. And the entire expenditure is reimbursed by the employer. So it is a perquisite. So expenditure incurred for such extended period is the taxable value of the perquisites. For official period, it is fine. It's not taxable. But beyond that, it will be taxable. Beyond that means the period of stay for which employee has stayed for personal purpose. Okay, for that period, whatever money is reimbursed by the employer, that will be the taxable perquisite. Did you understand this? Okay.
Yes, sir.
Right. Now, quickly let us cover one more perquisite. This is about credit card facilities.
Yes, sir.
Okay. Now, this is about credit card facilities. Sometimes employers give credit card to the employees for their use. You have to see the purpose for which it is used. If it is used for official purposes, it is exempted if detail of such expenditure is maintained by the employer. Employer maintains that these are the detail of expenditure, and employer also certifies that expenditure is wholly and exclusively for official purpose. Credit card is used and it is used for official purpose and detail of expenditure is maintained. In that case, it is exempt. But if it is used for personal purpose, then expenditures which have been incurred through this credit card, as well as the fees paid for maintaining of that credit card, all of them will be taxable as a perquisite. Okay, friends. Is it clear to you?
Yes, sir.
Yeah, this is the next perquisite. This is gift vouchers given by employer. So, yeah. For this thing, we need to refer to Rule 374. Okay, so you can go to Income Tax Rule 1962, refer to Rule 3, Sub Rule 7, and Clause 4. You can understand how this particular perquisite should be behaved. So, gift may be given to employee, and this gift may be given in cash or convertible into money. Okay, some gift vouchers can be given, which can be converted into money. And if this gift is given in by way of cash or something, some kind of voucher which is convertible into money, then you see it is fully taxable. But if the gift is given in kind, it is exempted of 2 rupees 5,000 during a financial year. So in aggregate, one has to see during the financial year, gift from employer, if it is more than 5,000 rupees, then it is taxable. If it is less than 5,000 rupees, it is exempt. Okay, so up to 5,000 rupees is exempt. Beyond that, it is taxable. Is it clear to you?
Yes, sir.
Now, next perquisite is club expenditure. So this is again one more facility which may be provided to the employee by the employer. So if you see, you have to see different types of clubs in this column 1. Column 2 talks about the tax treatment. You can watch here. The health club facility, it's not taxable. Sports club or similar club, it's also not taxable. These kind of club facilities are not taxable. Other club facilities used for official purpose. If the club facility is exclusively for official purpose, then it is exempted, but subject to certain conditions. Condition 1, detail of expenditure is maintained by employer. Employer must be maintaining what is the expenditure income. And point 2, employer certifies that the expenditure is wholly and exclusively for performance of official duty. If that is so, the employer certificate is there and employer has maintained expenditure details, then only it is exempt. Otherwise, it will be taxable. Then corporate membership obtained by employer and the facilities enjoyed by employee or his household member. So that is a corporate club membership is given to the employee. Employee is enjoying as well as his household members are also enjoying. In that situation, The initial fee paid for corporate membership is not taxable, but other expenditures shall be taxable in the hands of employee. Okay, so the fee will not be taxable, but other expenditure which is incurred in the clubs and which is reimbursed or facilitated by the employer, that will be a taxable purchase. Now, if club facility is provided in any other manner, then expenditure incurred by employer shall be taxable purchase in the hands of all employees. Okay, so this is the treatment of club expenditure incurred by employer per employee. Okay, friends. Now, next, this is an important concept. ESOP, that is employee stock option plan or sweat equity shares. Okay, employee stock option is basically an option given to employee to apply for specific number of shares in a company. So employee may exercise that option. If he exercise, he may get the equity shares at a predetermined price. Predetermined prices are normally less than the market price. Employees are given options. Suppose market price of the share is 500 rupees. Employee may be given an option to buy their shares at 200 rupees. So that is an ESOP or employee stock option scheme. Okay, so in order to recognize the contribution of employees in the company, this kind of schemes normally introduced. Now, what is sweat equity? Sweat equity is again a kind of equity shares which are issued to the directors or employees at a discount or for consideration other than cash. For example, employee has contributed something, the director has contributed maybe technically, maybe some kind of intellectual contribution. And for that thing, this sweat equity shares are issued. So if these shares are issued or these ESOPs are issued, it is a perquisite, but how it will be taxable, we are going to learn this. So it is a taxable perquisite in the hands of employees, both ESOPs and sweat equity shares. The fair value of shares and securities after subtracting the amount charged from the employees shall be taxable in the hands of employees. For example, the fair value of equity shares, let us assume 500 rupees. But the company is charging 300 rupees for the employee. So the balance 200 rupees, 500 minus 300 rupees is a taxable pork in the hands of employees. Right. And you have to also remember, normally it is taxable in the previous year in which such shares or securities are allotted or transferred to employee. When they're allotted in that year, it will be taxable in the normal situation. Is it clear to you?
Yes, sir.
Okay. Now, there is a special treatment for this kind of perks like ESOPs and sweat equity shares, which are issued by eligible startups. If it's a startup company and it's an eligible status, that means Income Tax Act has recognized that startup company as a company, then the treatment will be slightly different. Okay, so tax and perquisites of the sweat equity shares or specified securities is required to be paid at the year of exercising the option. First, what I told you, generally it will be taxable or tax will be paid in the year when it is allotted or transferred to employees. I told you generally it is made at that time. But if it is a eligible startup company, then the tax is required to be paid when in the year of exercising the option. When employee is exercising the option, in that particular year, it will be taxable. However, okay, in this case, if where such shares and securities are allotted by the current employer, who is an eligible startup, okay, then perquisites will be taxable in the year after expiry of 48 months from the end of relevant assessment. 48 months means how many years?
So 12.
48 months.
Sorry. So 4 years.
4 years. That means first one point I'm saying, if it is issued by the current employer who is the eligible startup, then after 4 years, or point 2, year in which the sale of such security or shares are made by the assessee. Let us say assessee is sold it in a particular year, in that year. Or point 3, year in which the assessee ceases to be the employee of the employer, or assessee, let us say, leaves the employer. So 3 points I told you: 4 years, or year in which securities are sold, or year in which the assessee ceases to be the employer. Whichever is earlier, in that particular year only it will be taxable. Okay. To understand this thing, we need to refer to section 80 IAC, and there the summary of that provision, summary of that section is here. So in case of eligible startup, the taxability can be deferred. So through proper tax planning, it can be deferred. Deferred for, at least, if someone tries, it can be deferred for 4 years. That's the benefit. So deferment of tax is also a kind of tax planning. Is it not? Liability you are not paying now, but you are paying up to 4 years. Understood?
Yes.
Now I told you the value will be how much? Value will be the fair value minus the amount recovered from the employees. Is it not? Okay.
Yes, sir.
So this is what I showed you: fair value minus or subtracting the amount charged from the employees. Now, how to know the fair value? You see, the rules provide like this: if the securities are listed in one recognized stock exchange, then average opening and closing price on the date of exercise of option. If on that date there is no trading, then the closing price as on the date closest to the date of exercise of the option, and immediately preceding such date. So preceding closing price closest to the option exercising date can be taken. Okay, normally average opening of average closing is taken. And if that security is listed in more than one recognized stock exchange, the average opening or average closing price on the date of exercising of the option on that stock exchange which records highest volume of trading. You have to see which stock exchange trading volume is high. So that stock exchange's average opening price or average closing price will be taken as fair market value. And if in that case there is no trading, then the closing price as on the date closest to the date of exercise of option and immediately preceding such date on stock exchange which records highest volume of trading will be taken. Friends, this was about listed securities which are listed in the stock exchange. One can easily get the opening price, closing price, all this thing, or previous price, all this thing one can get. But if these securities are unlisted, let us say just private company or a small company, then how to arrive at the fair value? In that case, fair value shall be determined by a category 1 merchant banker on the date of exercise of the option or other earlier date, not being more than 180 days. Okay, so fair market value shall be decided on the basis of the valuation report issued by category 1 merchant banker, but not being earlier than 180 days. That means it should not be more than 6 months old valuation. So recent valuation report within 180 days should be taken. Understood? This is how fair market value can be arrived at.
Yes, sir.
Okay. So now you must have seen so many kinds of perquisites can be provided by employer to employee. Here is one more perquisite. This is about LTC, or it is also called as LTA. As you can see, it refers to leave travel concession or leave travel assistance. And here, to understand the exemptions here, we need to refer to section 10(5), section 10, subsection 5. So here we have to classify this type of concession or assistance into two categories. That is LTC within India and LTC outside India. If it is in India, the stay and other costs reimbursed by employer, as you can see, is fully taxable. But travel cost reimbursed by employer is exempt. But exempt, again, some conditions are there. It is exempted on actual basis. However, in case of air, maximum economic class fare of national carrier by shortest route shall be exempt. Okay. Understood?
Yes,
And
sir.
if LTC is provided outside India, it is fully taxed. Okay, when I say national carrier, here refers to Air India fare. That means economic class fare of Air India by the shortest route shall be exempt if the travel is made by air. Now, let us learn these provisions in detail. First, you see what is the amount of exemption, and you can also refer to this table where situations are explained and exemption amounts are also explained. Okay, now you see the situations. If journey is performed by air, if on leave travel, employee goes by air, then amount of economic class fare of the national carrier by the shortest, or the amount spent, whichever is less, is exempt. If amount spent is less, then that amount is exempt. Okay, or economic class fare by national carrier, or that is by Air India, by the shortest route. You have to see the shortest route. Okay, suppose from here, Bhubaneswar, someone wants to go to Jammu and Kashmir. For Bhubaneswar, he has to see what is the shortest route. Okay, so maybe by direct or by through Delhi, one can go. That is the shortest route. But one should not plan that from Bhubaneswar to Mumbai and Mumbai to Delhi. Okay, Delhi to Jammu. If that is not the shortest route. Right. And where journey is performed by rail, again, the amount of air conditioned first class rail fare by the shortest or the amount spent, whichever is less. So first class AC fare or the amount spent, whichever is less, will be exempt. Where the place of journey and the place of destinations are connected by rail and journey is performed by some other mode of transport. Let us say both the places are connected by rail, but employee is going by his car. Places are connected by rail, but employee is going by his car. That means some other mode. Then how much will be exempt? The amount of first class AC rail fare by the shortest route or the amount spent, whichever is less. So if they are connected by rail, then one need to find out what is the first class AC fare between these two places by the shortest, or the amount spent. Amount spent means employee has gone by his car. What is the amount spent? Whichever is lower, that will be exempted. Now come to the next situation where we are seeing this place of journey, that is the origin of the journey and destinations are not connected by rail. Then if that situation, if places are not connected by rail, but a recognized public transport exists. Okay, let us say government bus goes there. Okay, recognized public transport exists. Then how much is exempt? First class or deluxe class fare by the shortest route or amount spent, whichever is less. That is exempt. So first class fare and deluxe class fare by the surplus to or amount spent, whichever is less will be exempt. And where recognized public transport doesn't exist, then first class AC fare by surplus to. Okay, we have to see as if journey is performed by rail for that much of distance, what is the first class AC fare by the surplus to, or amount spent, whichever is less, shall be exempt. Okay, so now you can understand. We have to see what is the first class AC fare, what is the economic class fare if when journey is performed by air, and or where the first class or deluxe class fare by the surplus to. All these things will be relevant for us to claim exemption for LTC. Okay, and some related points you have to remember. This leave travel concession may be received by employee himself or by his family for traveling to any place in India. Okay, and this concept you have to remember. This LTC exemption is exempted to the extent of amount of following. Following means exemption of 2 journeys in a block of 4 years. And here block means a calendar year. Right? Since now we are dealing with assessment year 22-23. Please appreciate that the relevant block here is the calendar year 22, 23, 24, 25. In these 4 years, that means calendar year 2022, 23, 24, and 25. So 2 journeys are exempt. Exemption you can get as what we saw right now. Right, traveling amount can be exempted from tax, but maximum 2 journeys in a block of 4 years. And these blocks are predetermined block, fixed block. For example, 22-25 is one. A previous block was 17 to 21. 17, 18, 19. Sorry, 18 to 21, 18, 19, 20, 21. Now it is 22 to 25. So in these 4 years, how many journeys one can undertake and can be which can be exempted? How many journeys? No, 2 journeys in the total 4 years. Not that for year 2. For year 2 total 8, it's not like that. So in this period, he can go for maximum for 2 journeys, which will be exempted. He can go any number of times, but maximum 2 journeys can be exempted. Is it clear? One more concept. However, out of these 2 exempted journeys, one can be carried forward to the next year of the next block, or carried forward to the first year of the next block. For example, I told you in the year 22, 23, 24, 25, you can travel twice, but you couldn't travel. Then, okay, in this block, you can travel 1 journey. 1 more journey can be carried forward to the next block. Next block is 26, 27, 28, 29. So it can be carried forward to the first year of the next block. That means in the year 26, you can go for LTC again. And that will be exempt. And the next block, 26, 27, 28, 29. That means you can have 3 journeys. 2 journeys, original journeys from that block, and 1 more journey which is carried out from the previous block. Okay.
Yes, sir.
Right. Now, here we're talking about leave travel allowances and leave travel assistance and leave travel concession, not leave travel allowances. Fixed leave travel allowances are fully taxable. Fixed means irrespective of your amount spent, a fixed allowances is given. That is fully taxable. And this LTA or LTC can be availed by family members, and family means spouse, children, parents, brothers, sisters. Okay, spouse, children is fine, but parents, brothers, sisters who are wholly or mainly dependent on employees will be included. An exemption can be given for 2 children And in case of multiple births, all such children shall be considered as one child. Okay, so maximum for 2 children, and it is allowed for all the children born before 1/4/1998. But if children are born after 1/4/1998, then maximum 2 children can be included in the family. If they are born before that, then all the children will be taken, can avail the benefit of LT. Okay, friends.
Yes, sir.
Now, next concept is that another project is that employees provident fund. Some of you might be aware of the provident fund laws, provident fund act. Some basic things I would like to tell you what happens in case of provident fund. If the provident fund laws are applicable to the employer, or if employer voluntarily adopts the provident fund law, what will happen? Employee will be contributing certain percentage of his salary. Employer will be also contributing almost similar kind of amount, and it will be deposited with that provident. Okay, employee contributes normally 12%, and employer's contribution is like this: 3.6% towards EPF, 8.33% EPF means employees provident fund, then 8.33% towards EPS means employees pension scheme, and 0.5% for employees deposit linked insurance uh, scheme, then 1.1% as EPF administration charges, and 0.001% for employee deposit linked insurance scheme administration charges. Like this, employer contributes the total amount. Okay, so all these establishment with less than 20 employees can voluntarily covered under EPF Act. If it is more than 20 employees, then mandatorily they have to follow the requirements of PFR. Okay, so as you can see here now, employees contribution is 12%. Employers contribution totally comes to 13.61% normally. So now 25.61% deposits. And these contributions are statutorily payable of 2 years prescribed wage salary as on date, which is 15,000. If the employee salary is within 15,000, this contribution has to be made. Okay, and registration is required if the factory or the industry or the office where 20 or more employees are working. Okay, this is, and for that thing, this PF returns has to be filed by 15th of every month. So these are the requirements in fact. Okay, employee can withdraw the PF amount on his retirement at the age of 55. Employee can withdraw the cumulative amount of EPF, which is there in his name. He can withdraw the whole amount of EPF account along with the employer's contribution. In case employee doesn't attain the age of 55 or below 55 age of retirement, but switches or changes his employment, he can fully withdraw his EPF balance if he is not in employment for 60 days or more. He can withdraw the entire money. Okay, so these are the provisions for withdrawal. So these are what I told you. This is a general understanding about provident fund. Now let us see from the point of view of income tax. From income tax point of view, we are classifying these provisions into 4 categories, as you can see in this table. One, we call it as the statutory provident fund. And one more category of provident fund, we call it as recognized provident fund. Okay, statutory provident fund means like government provident fund. I'll be explaining you in detail what is that. Recognized provident fund means a provident fund which is recognized by income tax department or recognized by commissioner of income tax. Unrecognized provident fund means it's neither statutory provident fund and it is a provident fund which is not recognized by income tax commissioner, but still it is a provident fund maintained by the entity. And the fourth kind of provident fund is the PPF or public provident fund, which can be opened in a bank or in a post office. And here you see below that one, here you can see under statutory fund, I have written EEE. EEE means it is always exempt, exempt, exempt. Okay, so various things, let us say what is exempt, we will be seeing it. Then recognized provident fund, you can see it is here is also exempt, 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 but with an asterisk part. That means subject to certain conditions, there are exemptions. Then coming to unrecognized provident fund, you can see it is exempt, exempt, and tax. Tax. Lastly, it is tax means the finally when it will be received. Okay, then it will be taxed. Lump sum money when you received at the end, that will be taxable. Then public provident fund, again I have written EEE, that is exempt, exempt, exempt. Understood? This is how we can categorize this provident fund: statutory provident fund, recognized provident fund, unrecognized provident fund, and public provident fund. Before learning how this treatment will be there, let me first tell you what is a recognized provident fund. Recognized provident fund means provident fund recognized by Commissioner of Income Tax for the purpose of income tax. It is governed by Part A of Schedule 4 of Income Tax Act 1961. Okay, this schedule contains various rules relating to recognition of fund, employees and employers' contribution, treatment of accumulated balances are there. Okay, if it is recognized provident fund, it is EEE. Unrecognized provident fund, it is not recognized by Commissioner of Income Tax. Statutory provident fund, it is governed by Provident Funds Act 1925. It applies to government employees, railway employees, semi-government institutions, local bodies, universities, and all unrecognized educational all recognized educational institutions. Public Provident Fund, they are operated under PPF Act, Public Provident Fund Act 1968. A membership of the fund is open to every individual. Okay, it is ideal for self-employed people. Anyone can go and open this account. One need not be an employee somewhere. Okay, salaried employee may contribute and non-salaried persons can also contribute to this PPF. Okay, so these are the four kinds of provident fund which we need to understand. Okay, now let us see this basic conditions, some basic situations. Today I am telling you briefly, maybe next class again I'll be elaborating this thing. First, you see employer's contribution. If it is a statutory provident fund, employer's contribution means the employer is depositing. Employer's contribution is not taxable if it is statutory provident fund. Employee's contribution, that is also not taxable. Now, as you know, from the gross total income, employee can claim certain deductions under Section 80C. And if the statutory provident fund, for the amount contributed by employee, he can claim deduction under Section 80C. Deductions are also allowed. Interest credited to this fund is also fully exempt. Lump sum withdrawal is also fully exempt. Okay, so deposit is exempt, interest is exempt, lump sum withdrawal is also exempt. Therefore, we call it as EEE. Okay, statutory provident fund. Now, coming to next fund, which is recognized provident fund. Employer's contribution. It is exempt up to a certain point, but is taxable if the contribution is made, or you can say excess contribution over 12% of the salary is taxable. So up to 12%, if employer is contributing, it's not taxable. Then excess contribution over 7,50,000 is also taxable. But here salary means basic salary plus DA forming a part of retirement benefit plus commission, which is fixed as a percentage of turnover. So recognized provident fund employer's contribution is exempt up to a certain limit. Beyond that, it will be taxable. Employee's own contribution is not taxable. Deductions are available under section 80C. And coming to interest credit, interest is exempt up to 9.5% per annum. Beyond that, it is taxable. And lump sum withdrawals are not taxable if retirement is made after 5 years of continuation of service. If it is not after 5 years of continuous service, then it is taxable. So therefore, if it is a recognized provident fund, it is exempt, but subject to certain conditions you have to remember. Right? Now come to next category of provident fund, that is unrecognized provident fund. This is a provident fund which is not recognized by income tax department. As you can see, employer's contribution is not taxable here. Okay, it's unrecognized provident fund. Employer's contribution is not taxable. Employee's contribution is also not taxable. Deductions are not available since it is not recognized. Deduction under section 80C is not allowed. Interest credited is also not taxable. Okay, but as you can see, it is EET. That means contributions are exempt, interests are exempt. But lastly, when it will be withdrawn, it will be taxable, EET. Now it is taxable when it is final lump sum is withdrawn. Employer's contribution taxable as salary. Interest on employer's contribution is also taxable as salary. So employer's contribution as well as interest are taxable as salary. Employee's contribution is not taxable. Then interest on employees' contributions are taxable under the head income from other sources. Employee's contribution is not taxable because he has contributed and he has withdrawn the same money. So it's not an income, it's not taxable. But interest earned on employee's contribution is taxable. But it is since it is his own contributions, interest, employer-employee relationship doesn't come into picture. So it will be taxed under the head income from other sources. Lastly, friends, coming to public provident fund. Here also it is EEE. Employer's contribution is exempt. No, sorry. It's a public provident fund. There is no question of employer's contribution. Public provident fund, employer-employee relationship may not be there. A person who is not working anywhere can also contribute. Let's say he's doing business. He's a self-employed. He can also contribute. The question of employer contribution doesn't arise. Employee's contribution, that means that person's contribution is not taxable. Deduction under section 80C is allowed. If interest is credited, that is also exempt. Lump sum withdrawals are also exempt. So here also it is exempt. But the only thing is that here employer doesn't contribute anything. Okay. Understood these 4 kinds of funds?
Yes, sir.
One more new concept which is relevant for assessment year 22-23. We have to remember. The exemptions I told you right now shall not apply to the interest income accrued during the previous year in the provident fund account of an employee to the extent it relates to the amount of contribution made by such person exceeding rupees 2,50,000. That means the interest earned by employee from this provident fund account on his own contribution, if that exceeds rupees 2,50,000, on that excess amount, whatever interest is earned, that will be taxable. That will not be exempt. Okay, so this is as per the latest amendment. You can say this is for assessment year 22-23. I repeat, These exemptions shall not apply to the interest income accrued during the previous year in the provident fund account of the employee to the extent it relates to the amounts of contribution made by such person exceeding rupees 2,50,000. Suppose employee has contributed 3 lakh rupees and he has earned some interest. Okay, the amount exceeding 2,50,000 rupees is 50,000 rupees, 3 lakh minus 2,50,000. All that 50,000 rupees, whatever interest is earned, that will not be exempted. Is it clear to you?
Yes, sir.
So this is about 22-23 amendment. Okay. Okay. And as I told you one thing regarding this recognized provident fund, certain conditions are applicable to them. You have to see these conditions. You see, recognized provident fund lump sum is not taxable on retirement or termination after 5 years of continuation service. So employees should be continuing 5 years in order to avail that exemption. Okay, but here there is some provision, some related provision. Here you have to see in that situation, has the employee rendered continuous service of 5 years with the employer? If it is yes, it is exempt. If it is no, then also you have to see why the services are terminated and why he could not continue for 5 years. Is it due to his ill health? Is it due to contraction or discontinuance of employer's business? Or is it due to some cause beyond the control of the employee? If it is yes, if answer to these 3 questions are yes, then it is still exempt. If it is no, it is taxable. Okay. Is it clear to you up to this?
Sir, I had one doubt.
Yeah, please raise your doubt.
Sir, I had wondered how do you do the deductions in section 24, sir? Children education, like where to add that and what to do with that in the old and new regime both?
Children education allowance.
Yes, sir.
You're asking about that.
Yes, sir. Section 24, sir.
Okay, so section children education allowance is not section 24.
Sir, I thought I studying, so I thought it is there.
Children education allowance has been taught to you.
Sir, there is a column like all other exceptions to be added after NPS. That is what I'm asking.
Wait a minute.
What to do with that?
Wait a minute. Try to first understand how children education allowance will be treated. So you know, children education allowance and hostel education hostel allowances. We have learned earlier. We have done a question here also. Now you can have a look. Children education allowance 100 rupees per month per child if these allowances are given, or actual allowance given, it is allowed. And if it is hostel, you know, additional 300 rupees will be allowed. So additional 300 rupees, this will be allowed. Okay, and for that thing you have to refer to section 1014 to understand this thing. Now your question is that how this exemption will be claimed. So you see, in the salary, if it is already included, then it is fine. Okay. Okay, then you claim a deduction from there for this children education allowance, only 100 rupees. If hostel is there, another 300 rupees. If both are included, then 400 rupees per month per child. Like that, you compute the deduction and find out what is the taxable amount of salary. So arrive at the taxable amount of salary. From your salary, this amount has to be reduced. That is the concept. Now, what is your other point?
Sir, like I found out that the new regime doesn't have the deduction apart from the NPS, they are not allowing. So in the old regime, it is allowed. The other allowances.
Yes. So what are the allowances allowed under old regime? That we had also discussed at that time also. We had seen, refer to our earlier sessions, you can find out that these allowances are not allowed under the new scheme, for new scheme.
Okay.
Okay, so please refer some of our earlier videos There we have discussed which are not allowed. Okay.
Okay, sir.
Okay. Once again, if possible, some other time I will again cover that thing. But slides are there. If you refer to their videos, you'll be able to find it out.